Okay, so welcome to the Cannabis Data Science meetup for March 17th, 2021. Visit Cannalytics if you want, more information and you want to contribute to open source research on cannabis analytics. Today, I thought it would be interesting to look at the rates of return on capital in the cannabis industry. Last week, we looked at the real wage that workers can be expected to be paid. So this week, it would be interesting to look at the other input, which is capital. If you look at an article by Polson from 2013, so it would be interesting to look at the current rate of capital. He finds that there's he expects that there are high rents from capital because you have a semi-legal market. So the states consider it legal, the federal government still considers it illegal, which results in a high rate of capital because large banks and investors are often hesitant to lend to cannabis businesses. So when you start a business, you may need to take out loans. And then investors also want to get rate of return on their loans. So it's interesting to know what the rate of return is in the cannabis industry because you may expect it to be high. So we're going to use a similar production function as we used last week. However, we're going to use an even simpler production function. So first, we're going to take the simplest model, and we're just going to assume that cannabis sold in a given period, YT, is a function of the number of plants, KT. So, and it's augmented by technology, and there's a random element, and so that'll be epsilon, or random shot. So, of course, the actual production of cannabis is more complicated than just cultivating plants and turning that into revenue. However, we're going to abstract just to create the simplest model, and then you can expand on it to make it more realistic. So if you plot these variables against each other, we can start to see some trends. So if you plot retail revenue against cultivated retail plants, you do see the positive trend like we would expect. And there may or may not be diminishing marginal returns. What that simply says is you would expect that the more plants you cultivate, you're going to get you're going to get less and less revenue for each additional plant. So as you grow more plants, the overall cannabis becomes less valuable, and so the average price per output decreases, and you're only going to be able to get so much revenue from that from the additional plants cultivated. What's interesting to note is that there seems to be a lot steeper. It seems that diminishing marginal returns have taken place in the medical cannabis market. So if you just look at the comparison, you can see that there's between 300 and 350,000 medical plants cultivated. And the time frame on this is 2014 through 2016. At the same period, retail plants went from 50,000 to 450,000. So you see high rate, you see high returns in the beginning, and as the market matures, like in the medical industry, the medical markets, you get diminishing marginal returns. So we're interested in estimating alpha, and we expect that it should be between 0 and 1. So we can take the production function from earlier, and we can simply take the log of both sides, and then you can estimate it using a linear regression. Once we estimate it, the competitive rate of return is equal to the marginal product of capital. So if you take the derivative, are you still there, Charles?
Yes. Yeah, you froze up.
Okay, so I must, well, that's why we're recording. So anyways, we're back now.
Yeah.
So where was I when things cut off?
So let's see. You're taking the log of both sides, and you were going to estimate alpha, and then it was just right after that.
Okay, so we take the log of both sides, and then we want to calculate the marginal product of capital. So capital is KT. Right, so that's our number of plants.
Right.
And so we want to estimate alpha. So if we take the log of both sides, we can run a linear regression of the log of sales. Right, so we've got the log of sales, and then this is going to be a constant.
So your slides aren't showing now.
Okay.
Okay, yeah. Now
Okay. Okay, so we're back.
Yeah.
Okay. Okay, so just to kind of get back into things. Okay, so just sort of to do a recap here after sort of that bumpy transition. Okay, so we've got the total amount of cannabis sold, and that's YT. And that's going to be a function of the number of plants, KT. So we've got our production function. We take the log of both sides, and we get log of cannabis, log of sales equals a constant plus alpha log of plants. So we can estimate this with the linear regression. And then given alpha, we can find the marginal product of capital. So that's the marginal product of capital. And so that's simply the derivative of the production function with respect to alpha. And so that would be how productive your capital is going to be. And then we're going to subtract off depreciation. And for this simple example, we're going to assume 0 depreciation. So in reality, there is depreciation. So once again, this is the simplest model. And then this is just the simplest way that you could estimate the rate of return on capital. And just to go ahead and look at the empirical literature, so we can go ahead and get our Bayesian prior. We saw in Polson's paper that the interest rates, are typically between, 7 and 15%. And so that was from Polson's research. And so we want to look at data that we have and see if we can estimate a marginal product of capital. So let's go ahead and jump into that and do just that. So I'm going to share with you the data resources. So here, there's so here is the Colorado Department of Revenue annual updates. And so you also have them quarterly as well. And so for these particular updates, they're simply PDF documents with tables of data. So here you have the number of stores, you have the occupational license data, you have the number of plants, you have retail, well, this is retail plants, but then you also have flowers sold per month. And then you get down here to a breakdown for the different product types. So, and then you also have total sales. So we'll be utilizing that as well. So we're not given the rate of return, but we're given just these raw data points, and we're going to figure it out. And for future research, it may be worth looking into the testing data here. So it could be worthwhile to compare what's going on in the Colorado testing market versus Washington. But these are the data sources. So they're a little tricky. You have to sort of essentially copy and paste out of these tables. And I've done that here. And I've currently got through data through December of 2016. But as you can see, there is data through October of 2020. So for future exercise, and I'll be adding this to the Cannabis Data Science GitHub repository, but we can essentially get the latest data and calculate the rate of return up through 2020. However, for this exercise, we'll simply calculate it through 2016, since that's the data that I've already compiled. So let's go ahead and just jump right into that. I will be using Spider in Python. Of course, you can use your favorite programming language and text editor. However, I find Spider simple and easy to use. Not glamorous, but easy to use. So to do this, we only need 3 Python packages. We just need NumPy, pandas, and stats models. Next, after importing the packages, you can import the data. And so I'll just be importing this spreadsheet here, which I'll make available on the GitHub repository after the presentation. Once you've read in the data, of course, number 1 rule, look at the data. So you've got some observations. Or columns. Essentially, we just have date. I grab the number of licenses for future work. Then we can do number of plants, cultivations, and revenue. So these are variables that will be useful. However, as you saw in the reports, there are many more variables that you could grab to do further analysis. So we've read in the data. Now, if you go back to our model, we need to calculate the log of sales and the log of capital. So we can use numpy, np.log, and go ahead and create the log of retail revenue and the log of retail plants. And now we can do a simple ordinary least squares regression of the log of sales, YT, on a constant, which will be the log of technology, A, in addition to the log of capital, which is retail plants. So we can go ahead and fit this model. What's interesting to observe is for such a bare bones model, so we have got 36 observations, you do have a decent R squared, so we are explaining a lot of the variation. And retail plants, it's significant to the 5% level. So like I said, there's this model, it's got its flaws, but there does seem to be correlation between the number of plants grown and the amount of capital. One should note that obviously cannabis grown in time T is not sold in time T. So it may be more realistic to estimate an autoregressive regression where you would estimate YT sales on KT minus 1, KT minus 2, perhaps all the way up to KT minus 6 or more. When that would simply mean that sales today are dependent on the plants grown 6 months ago, or 1 month ago, or 3 months ago. So it would be an interesting analysis to add multiple lagged capital variables and see if that has a more significant effect. But that's research for the future. So in our regression, if you go back to our presentation, you see that we're looking for alpha. So we're looking for the coefficient on log t. And so in that case, that's going to be 0.67. So we can go ahead and grab alpha. And now that we know alpha, we can now calculate the rate of return on capital, which will be alpha times kt to the alpha minus 1. And we're assuming depreciation is 0. So we can program that in Spider. So here we have alpha times kt, which is retail plants, to the alpha minus 1. And I'm multiplying this by 100 because I would like to display R as a percentage. And remember, R is the real rate of return of capital. And so let's estimate that, and then we'll talk a little about that. Rule number 1 about data, look at the data. So here we have what we have estimated to be the real rate of return of capital in the cannabis market in Colorado from 2014 to 2016. So what we're essentially estimating is we're saying that an investor would expect a rate of return of 2.6% in 2014 to about 1% in 2015. And that would be our at time t, so that would be, a monthly, that would be their monthly rate of return. So they would like to get a 2% to 1% rate of return per month. And then this would be if everything was entirely efficient. But as Polson noted, he observed that interest rates were typically between 7 and 15%. So this model doesn't take into consideration risk. So risk is likely driving these interest rates well above their real rate of return. Like last week, we noted that when we added in our uncertainty that we couldn't be quite so precise in our estimations. So let's add our confidence intervals. So what is our confidence interval? Well, remember earlier, we estimated alpha to be 0.677. Our 95% confidence interval, so we're 95% sure, given the data at hand, that alpha, given the model at hand, is between 0.6, about 0.61, and about 0.74. So that's our 95% confidence interval. And so we can calculate our upper and lower alpha. But those are our upper and lower alpha. So we can calculate our upper and lower interest rates, and we can plot them. And so now you see our original estimation with interest rates being roughly 2% and dropping to 1%. And then you see our lower estimation with interest rates being close to 1% and then dropping quite low to well below 1%. However, our upper bound on our confidence interval is starting around 6 or 5% and then drops down to a little above 3%. Once again, this is a crude estimation. We're using plants to proxy capital, and we're excluding labor. So for future work, you can estimate what's called a Cobb-Douglas production function, where you augment the production function with labor. So a Cobb-Douglas production function, you can estimate the same model and add another regressor, and that's just going to be beta log LT. And so that's going to be your labor. And so you can estimate a more realistic function simply by adding the log of labor to our regression. So I'm going to leave that as a future exercise, and I'll go ahead and do the code and post it to the GitHub repository, the Canlytics Cannabis Data Science repository. So you can check it out there to see the latest code after the presentation. So we set out to estimate the rate of return on capital. We knew that because the cannabis industry is still gray in terms of legality, that there would probably be a high rate of return on capital. However, our model does not factor in any sort of legality. Our model is simply a function of cannabis sold and plants. So we've got cannabis sold and plants. Of course, we also have technology and then a shock to explain the random variation. So given this simple model and ignoring the legality, we saw that there does appear to be diminishing marginal returns as medical plants increases. Next, we estimated the production function, which was simply the log of sales on the log of capital. For future work, you could add labor. And then we were able to estimate the actual rate of return of capital. And so here, based on our research, we can actually estimate the mean rate of return between 2014 and 2016 in Colorado. And so we're saying it's It's as low as 1.2.6%. Right, so just approximation, we'll say 1.25. So the rate of return is, the real rate of return could be as low as 1.25% per month. So investors in the long term would be satisfied with a rate of return that low for that amount of production. And likewise, businesses would be looking at low interest rates for taking out loans for capital equipment for their cultivations. What we currently see, as far as in 2013, is we saw that so this is real, right? And then here we have the actual. And so the actual rates of return that we observe are between 7 and 15%. So that means risk is explaining between, 6 and, about 6 and 14% of the rate of return in the cannabis industry. Also, I would like to mention that this is a monthly rate of return, and this may be an annual rate of return. So it should be, we may want to convert this to APR to make a good comparison. However, what you could take away from this is that as cannabis becomes more mainstream and as additional states continue to legalize, so that's what we've seen since 2016. So from 2016 to the present, 2021, we've seen more states legalize cannabis, cannabis production and cannabis markets. So, and it would be interesting to do research to see if cannabis laws and regulations have loosened in the states with legalized cannabis. Long story short, early on in cannabis markets, we saw high actual rates of return. However, we estimated the real rate of return would be low. So we would predict that over time, cannabis businesses may see their real rates of return decrease. So over time, it may become easier and easier for producers, cultivators to take out loans, whereas investors are currently making large margins because they're taking on a high amount of risk. So you would expect the margins for investors will decrease as the risk decreases. And with that brings us to the end of the presentation. And so I'll go ahead and just cut back to the meeting. If you have any questions.
No, that was a really good presentation.
Thank you.
Yeah.
Exactly. So essentially, last week we looked at the labor input. So we saw, okay, we estimated the real wage for labor, right? Because essentially that's what economics is. That's what a purpose of economics is, sort of estimating the prices in different markets. So that's actually the labor market. So the wage is the price in the labor market. And the rate of return is the price in the capital market. So the wage is what you pay for labor, and the rate of return is what you pay for your capital input. In this point, in this example, we proxied it with plants. So we're basically assuming, okay, for every X amount of plants you grow, you have to invest a certain amount into capital. And then when you put together labor and plants, you get output. And so in this case, it's going to be cannabis sold. And so we're also abstracting out the retail component because, of course, the cultivators are producing the raw flower and plant material, some of which is then manufactured into manufactured goods and edibles, at which point they're then sold to the consumers for the actual revenue. So our model abstracted away a large portion of how the industry actually operates, but it's an abstraction, and so there's a lot of room for improvement. So I think I'll leave it there, and like I said, I'll make the data available, and so we can add data up through 2020, so that way we can see how these estimations evolve over time, and we can maybe even compare our predictions to the actuals. So we looked at data from 2014 to 2016, and we made some hypotheses. I personally predicted that the real rate of return is going to continue to decrease. So now we can look at the data and see what happened.
Okay. Yeah, that sounds cool. Another thing I was thinking about was price of items sold compared to number of licenses.
Exactly. So you can gauge sort of how much each company is taking away at the end of the day.
Yeah, and as competition increases, price goes down.
Exactly. So we may not have the best measure on price. We could proxy it because we have total revenue in Colorado. Well, we may actually have prices in Washington. Actually, that could actually be a good analysis for Washington, because you're right. You could. I mean, one way to look at it would just be, I guess, total amount of revenue per retailer, and then you could see the market share. In Washington State, you can actually calculate the actual market share per retailer, and you can make estimations of the market concentration. In fact, have you heard of the Herfendale? It's HHI, the Herfendale Hirschmann Index.
No.
And so I may present that next week because it's actually one of the simpler measures of market concentration you can do, and it's easy to calculate if you have the right data. And in Washington State, we do. So you simply need to know the market share per retailer. So retailer A has share 0.3, retailer B has market share 0.5, and then you actually do the squared. So it's just the sum of all shares squared. So it would be 0.3 squared plus 0.5 squared plus 99.2 squared. and you would see, oh, that's an incredibly concentrated market, because I forget, I think I'll need to do a bit of research and tell you more about it next week, because I forget off the top of my head if lower numbers or higher numbers represent sharper concentration. But I want to say higher numbers represent larger, because I feel like if it's close to 1. But anyways, I may touch on that next week, because that's something that I've been wanting to look at. And it seems that's your idea as well, is it would be interesting to look at the concentration in the cannabis markets over time to see if it's becoming more competitive or more concentrated.
Yeah, that would be great.
And we can do it statistically, and we can plot it over time, so that way we could even see month by month the competitiveness. And it's interesting research, because you could start to find trends, and you can maybe find if any actions. So if you notice any point in time where there was a big change in the competitiveness, you may be able to pinpoint a piece of legislation or something that happened that changed the competitiveness of the market.
Yeah, yeah.
So I think, of course, I don't think we have time today, but I think for next week, let's look at just that, because that's the simplest measure that I can think of to look at market concentration. In Washington State, we do have the data. It's in that giant sales data dump, so it's possible, and it's going to be a good excuse to look at the data. So that's our philosophy here, correct? Is look at the data. So I think we've got a good project for next week.
Great.
All right, Charles, I think I may just go ahead and wrap up a little early today, unless you have anything you want to talk about.
No, not really.
Okay, well, I think for today, let's just go ahead and wrap up 10 minutes early. I sort of went through the presentation quickly. I didn't anticipate moving through it so quickly. So I could have added a bit more detail. And so like I said, I'll add a bit more detail to the actual GitHub repository. Just a little technical error. Didn't get it committed before the presentation, but I'll commit it right after. And then, we'll look at market concentration next week. And, let me know if you have any questions about this economics.
Okay, cool.
Awesome, Charles, and everyone. So, thank you for listening in, and I'll see you this time next week.
Okay, yeah, see ya. Bye.
Bye, Charles.